Hi guys. So today I'm going to explain to you liquidity. All right. So I'm going to continue on the previous lesson that we have discussed liquidity. I touched on the basics of the liquidity, but today I actually want to explain just one more concept on the liquidity and how to identify liquidity. All right. So let's say the price is going down, going up, and then it's going down and up, and then it comes back here, and then it rallies. Okay, it starts rallying. So what I want to tell you guys is that at the bottom here, we have two equal lows, almost two equal lows. That one, which is a liquidity. All right. So that's a liquidity for the future. So for example, if the price is still rallying upside and still continues to rally, the first point that we need to look at, or the strongest point that we need to look at, is that when we have two equal lows, all right, at the bottom, or when you have two equal highs at the top. So this is a very strong liquidity. All right. So what are other types of liquidity as well? We don't have just this one. So let's say the price is moving up and then it moving in a range and it keeps hitting the same bottoms. All right, the same bottoms. So these are all called relative equal lows. All right, relative equal lows. All right. So if the price engages in a higher movement, just know that at a certain point of time, if it is going down, it is going to take this liquidity at the bottom in a very, very, very rapid way. And you want to enter this trade when that move is happening. So as soon as that move starts to happen, you want to enter the trade, put your profits at this relative equal lows liquidity, and then take it up. Okay, leave the trade, and that's it. That's the basics. What I'm trying to explain. The same thing happens when you're in a rise. You're gonna have a relative equal highs, and that's the liquidity. All right, that's a buy side liquidity. Why? Because we have relative equal highs. All right. So when you have equal highs, there's a liquidity standing there, and the price, what it did is that it started to engulf all these orders. It started to take in all these orders at these points and send the price lower. So where would the people that are sending the price lower put their stop losses? At these highs, above these highs. Okay, so that's where our liquidity is. Liquidity is hunting stop losses. Okay, it's a stop loss hunt. So the market makers, what they do is that once they finish taking out their profits from this sell, they'll start to go on a hunt. All right, where do they hunt? Taking out the liquidity, and where does it stand? At the stop losses. All right, every single person who has sold here, they put in a stop loss and forgot about it, and they did not exit the trade. That's their punishment. The market is gonna go trade through it and take it as liquidity. All right, so the other people are liquidity. So let's go see it in price action, okay? Let's go see it in the prices and how it is going to make it happen, okay? So let's go to the daily. Oh, the 1 week, not that much information there. So let's go to the weekly, yeah? So when I'm looking at the charts, I want to be very zoomed out, all right? I want to be at least to see a lot of candles to get as much information as I can, all right? So in the daily charts, I can see that there is relative equal lows here. So I mark it. So there's relative equal lows. I take it from the bottom of this candle there. All right. So the bottom of that candle, yeah, that's where my sell side liquidity is. Why? Because we had the relative equal lows here. And let's go see it in the daily as well. There's another catch to it, okay? So there is just above here, we have relative equal highs. Why? We have two candles almost near to each other, as you can see. That's a buy side liquidity, all right? And where do we find another liquidity? We find it there. You see, that's another liquidity. It gets taken out by these candles here, all right? It gets taken up by these candles that are over there, okay? So they take them out and they form another buy side liquidity. So we put we put the line there and mark it for the future, all right? So the price goes down, it gives us an order block there. So as you can see here, there is an order block. Yeah. So once the order block is there, it gets fulfilled by this drop down here. It gets filled again and sends price higher. Where does it send it? Above these highs, liquidity. And you can see it. So as soon as the liquidity is taken, we start to see some rejection around this area. Yeah. So you can see we have a rejection candle. So this black candle here, it's a seller's candle. It's a bearish candle. So when that bearish candle forms, it's that when the liquidity is taken out, a bearish candle is formed. Okay? Not all the time and not necessarily, but we will just see a strong momentum of sellers. Why? Because the buy side liquidity, people who are buying at this low here, are taking out their orders there. And what happens when the buyers are taking out their orders is that there is a sort of a small proportion, okay, of sellers that will be overcoming the buyers. So what will happen is that we will see some kind of rejection at this liquidity. And then price is aiming for another liquidity, which is these two equal highs. So what does it do? There are some new form of buyers that are buying at this location, and they're sending the prices up higher. Okay, once they take up the liquidity, our intention is to exit at this liquidity here and at this liquidity here. All right, so we take out almost 50% or around most of our trades, not below 50%. Okay, and we just want to account in case price wants to drop back down and take back these liquidities at the bottom or takes out this order block. So the order block itself can actually act as a liquidity in a form. The fair value gap can also act as a form of liquidity. All right, these are all coming in the future lessons. I will explain to you what is an order block, how to identify an order block, and even the fair value gap, which will also help us into understanding liquidity further. And why do we need the fair value gap into our liquidity lessons? All right. So this is how the market is moving. The market is hunting liquidity. So these are the examples I wanted to show you. And let me delete everything before we go to the next one. So let me delete everything. Okay. So once the market takes this liquidity up here, okay, once it's overcoming that liquidity, it starts moving in a ranging movement, going up and down, up and down, up and down. And then suddenly we see some sort of manipulation, all right? The market begins a trending movement. So the market is always in a trend and it's going in a trend. It keeps going high, it's going higher because of some geopolitical news and things that are happening that send gold up higher. So in this way, we can understand that there is some form of deliberate movement on the market that we do not understand. But as retail traders, what we can do is that there are other forms of tradings that we can do. So let's say the liquidity has been taken and our bias is that the market is going short. So most people are going to sell here, thinking that this will be the breaker that will take them down, all the way down and up in movements. But of course, the market doesn't move in that way. If the market is in a trending position, you need to start thinking like the market makers. If I'm a market maker, what would I do in order to gain more profits? I would send the markets higher. Why? Because I already entered here at a good position down, and now I'm trying to send the markets higher. So there's another order block that happened here. So if you see this portion here, that's an order block. So why is an order block there is that we have a candle, okay? I'll explain it lightly on the order block side. What do I mean by the order block? So we have a candle there, okay? And another candle down, okay? 1 second, let me zoom in. Okay, and we have another candle. Let's draw it here. All right, so we have, let's say we have these 3 candles. They're making a pyramid to the downside. So this type of form of a candle is basically showing us a bullish order block, okay? it's showing us a bullish order block. So where do we enter exactly on this order block? We try to enter at the top of the candle, all right? We try to enter at the top of the candle. Sometimes it doesn't allow us to do so, and it just gives us a portion of the wick of the candle, yeah? A portion of the wick of the candle, and then it starts to rally, all right? So that's exactly what we are seeing here. So this is the movement down. It sends the price back up, okay? And the price deliberately goes down again to this order block that's over there. You can see at the top of this candle, the orders are being filled and rejected. It did not close. The body of these candles did not close within the close proximity of this candle, the order block. So it rejected that pricing immediately. So there's once, and now it goes twice. And then as soon as the orders are filled, you can see the consequent days that the price is being sent rapidly upwards into very fast movements. Whereas the first liquidity that we are looking at is these relatively equal highs. Like I said, when we have equal highs in near proximity to each other, that is also considered as a liquidity. So what does price do? It targets that liquidity in a very strong movement, as I have said before. So it sends prices even higher and higher, and it keeps going back upwards. So this liquidity is actually referred to back again at this point. And what we can see is that there is this candle, the buy side imbalance, okay, and a sell side inefficiency, yeah? So the buyers are here engulfing it. So as you can see here on this candle, the price has moved down to it, closed below the 50%, and that's where I thought that the market could go actually down, lower prices. But no, we were wrong about it, and the price kept going up higher and higher and higher. It kept sending it higher and higher and higher. There's another reason why it rejected at this point, but we'll discuss it later. So it kept moving up higher and higher, sending the prices higher and again high. But then over here, where the price is actually trying to reject higher pricing, and if it fails to reject the higher pricing, we could see the 3700s reach. Why? Because over here, there's these three candles, okay? These three candles formations, and the closure of this volume imbalance could actually send the price higher. So we closed at the 50% of these three candles downwards. They could act like an order block, okay? These three candles could act like an order block, and you can see we did not close, okay? We did not close below these three candles midpoints, and we're actually trying to move upwards. So this could act like an order block, all right? Whenever you see this, this is also like an order block, which is delivering in a form of 3 days and 3 consecutive candles that are going downwards at the same time. And these candles, the high, okay, or the wick is not going past the top of the candle, okay? It's not going above the top of the candles, okay? The high of the candles. So when I see that, I can see that there could be a formation of an order block in form of these 3 candles. So when I see it, I can understand that maybe the price could be sent up higher to target this liquidity. All right. This wick in itself, because there's an equal body there, I will take and consider this wick as a liquidity as well. All right. Even this wick that's on its own here, I'll consider it as a liquidity. So if we take it to the left side a bit, we'll see that it is in a close proximity on this wick at the bottom. So this forms a liquidity on the daily level, all right? So whenever we see something like this, we should always mark it on a daily level first. And then as we move in further in time, we go to the 1 hour, okay? We go to the 1 hour, we remove these markings, okay, this red bar, and we go visit it, okay? Let's go visit it. So as you can see, the 1 hour confirms that we have a liquidity. There's 1, there's 2, there's 3. Price did not go below it, and price is just playing around this area. So it did a higher low and a higher high, higher low, and now there's a break of market structure. Could the price go lower? We don't know. The market is currently closed. It will open tomorrow. So what could happen if price goes lower? Do we see another form of liquidity? Maybe. So if you mark it from here to there, you can say that there is another form of liquidity. There's an equal lows. But you're going to say, why does it take that much time? Why is it this much time? And how come that you're going to say that this far candle on the right side is referring to this candle? Yes, it is. It is referring to it. Otherwise, it wouldn't have rejected it. Why did it reject at that candle? You're going to show you. I'm going to show you. It rejected because we have a bullish order block. So because of that bullish order block, price got sent through it, okay? Price got sent through it, taken some orders, and then sent back up high. But does it always happen? No, not really. But when it happens, it's showing us quite a strong liquidity form, all right? So whenever I'm marking these liquidities and whenever I'm doing them on the daily, it gives a strong emphasis on the lower time frames. Okay, when we're going to the 5 minutes and the 15 minutes, so all of these are going to match, and you're gonna see the same exact thing in the 30 minutes, same exact thing in the 5 minutes and 10 minutes. You're gonna see it everywhere. Okay, it's just that when you're on a higher time frame, you will understand that in the upcoming days, maybe the 30 minutes has not reached the sell side liquidity, but it gives you an in-depth analysis that in the future, all right, within few days, within an hour, within 2 hours, the market is having that sell side liquidity. So whatever liquidity that it is forming, the 5 minutes and 15 minutes will be drawn into it. Okay, it will respect the higher time frame liquidity. It will not just randomly go to the 5 minutes liquidity for some reason. No, it will respect the higher time frame liquidity and it will eventually move towards it. So no matter what trade or operations are happening in these orders, okay, that are being filled here, it will eventually be following it to the liquidity on the higher time frame. All right, it will eventually send the price lower to the liquidity that is on the higher time frame, and it could also send it higher. Okay, so we have a kind of an indecision because right now it stopped at the 50%. So we never know what the market makers are thinking, and you guys cannot predict it 100% that what the market makers are doing. It's just that when we have some confluences and we have a liquidity margins, we at least have some idea where the market could be going instead of just entering blindly into the market. Yeah? So I'll leave you to it, okay? You guys, what you should do, I give you an assignment, is that go to the charts, all right? Let's say I go to a random chart, okay? I'll go to a random chart like that. Wow, I entered to a stock market, which is a very worst idea that I should have given you. We go to, let's say, YMU, which is the worst thing as well. The YMU, basically, what a YMU does is that, let me explain to you. So YMU is the Dow Jones. It's a US 30, top 30 stocks. This is kind of the worst stock that I would advise anyone to trade on. I would advise you to go to NASDAQ, okay? And I would advise you to go to ES, okay? You can go to Euro USD, any of the forex pairs, okay? Like USD JPY. For example, the USD JPY has these equal lows here, okay? These equal lows there. And it has this equal low here, all right? Relative equal lows, yeah? And it has these relative equal highs that got taken out, all right? So this is how I want you to do the analysis, all right? Find the relative equal highs, see how the price reacted, and how did it send the price higher, okay? Just understand what happened before the price went higher. Just keep that understanding of it, all right? So for example, here we have relative equal lows, price went up higher, and then started to go in a ranging movement until it took it out immediately, and then it went back up, it bounced back up, it did another sell side liquidity down there, and then the price went through it again. All right, so that's how I would understand the market. The market is always forming some sort of liquidity, and then there we go, we have another buy side liquidity that's over here, which I think the market is trying to aim for at the current stage. So the market USD JPY could actually aim to go up higher to this point, to the 150. That's how I understand it, and that's how we see it. But I also would rather prefer to go to the daily, understand the daily first, and check whether my confluences, whether my liquidities are valid. And as you can see, what I have marked in the 30 minutes actually is validated on the daily. So we have a liquidity there, we have a liquidity there, and we have a liquidity here that could have been missed on the 30 minutes. And when we go up, we could have a liquidity up there. The highest point, okay, in a single candle, that also can be a form of liquidity. All right, we have also relative equal highs over here. That's also a form of liquidity. So where is the price going? We are unsure yet where the price could go, but I can see that there's a huge amount of liquidity that is standing below these 3 points. You see, these are all relative equal lows. So I expect price actually to go downwards, take this liquidity down, and even further take it on the left side here. Take it on this left side here. I would rather see that happen. Okay, I don't know. I don't trade USD JPY, by the way. I don't even know how the forex trades are happening and how would it go. I've only entered the CFD market shortly, but I haven't been in there for so long. So I can always tell you that this one could go down because that's what I'm reading from the charts, and all the charts are working in the same choreography and the same sample of data, and they're working in the same formula. All right, the same algorithm is moving these markets, all of them, the same algorithm. So whenever moving down, and we accept that the market is moving towards liquidity and that the market is always seeking to take out liquidity, then we can always formulate a trade idea on where the market could possibly go next. Okay, so try to highlight all these liquidities on a daily and then see how they are magnified into the 30 minutes, into the 15 minutes, 5 minutes, into the 1 hour, 4 hours. Just keep playing around and see how is this liquidity being swept, and at which time of the day and at what news did this market actually navigate or manipulate itself towards these liquidities. All right, so I'll let you guys do it. This is how liquidity works. We have equal highs, we have equal lows, or we have the highest high. All right, the highest high. All right, so the highest high and the lowest low of the week, that could also be a target. There are further more concepts on liquidity. I will explain them not in the form of a liquidity lesson. No, I'll explain it in a different wording, like Orderblocks. I'll explain it in fair value gaps. I will explain it into another strategy that I'm using currently, and it will help you quite enter into a trade, an actual strategy that will help you formulate trade points and how to enter to the market with less fear. And I want you to enter the market with an idea before you initiate or press the trade button. All right, for now, I'll let you guys do the assignment and see you next time.